us now is Allspring's Patel and Bank of America's Diczok. Let's begin with you, Margie, and start with the big call for 22 for you. Where's your conviction at the moment, Margie?
I think the economy is going to be very strong. I think the Fed will continue its policy of keeping rates very low, disappointing aggressive people. And I think the stock market may well surprise on the upside and have another very, very good year after a very good year in 21.
Margie, when you say very low for interest rates, what do you mean by that?
I mean where they are right now. I think the Fed has basically for a number of years followed a policy of keeping interest rates very low, well below inflation, as have all the other major central banks followed that same policy. And I think they're actually quite pleased with the results. So I think the Fed is very, very reluctant to raise rates aggressively, slow down housing, maybe raise unemployment. That's their other really main goal, is keeping unemployment rates very low. So I think they will disappoint the market in thinking that they're going to be aggressive. I think they will be very passive. If they're ignoring inflation, I'm going to ignore inflation as far as that being a factor in my investments and what the Fed might do to rates.
Well, that's an outcome right now. We'll come back to what it means for your investments. Diczok, let's bring you into the conversation. On the Fed, can they ignore inflation?
No, they can't. They finally figured that out, and that is a good thing. Obviously, they had a big pivot in December, but more importantly than the pivot itself is the fact that they have decided they could be more nimble. It took them almost 6 months to prepare for the taper timeline they laid out in November, and then less than 6 weeks later, December, they totally flipped the script, doubled the taper, with potentially 3 rate hikes next year. So this is, in our opinion, a good thing. The Fed needs to be more nimble. It needs to react better to incoming data. Clearly, the data has said they're behind the curve. They're trying to figure out now how far behind the curve they are, but they're definitely behind the curve, and they are going to get out in front of the curve, hopefully at some point in 2022. And that is one of the reasons the market has taken this so well. They don't want a Fed on autopilot. They don't want a Fed that's not nimble to incoming data. So being more proactive, getting off the zero bound, getting to a more normal level of rates will be the right thing to do. And so this should keep the economy humming along. And you can see that in the yield curve. Yield curve has been flattening dramatically, especially 1030s. That pause around 30 or so, and it's back to 40 basis points or so. That's a good normal level. And so the yield curve has definitely stopped its flattening trend the last month. That's a good sign from our perspective.
Two different views here, so let's push you through the bond market just a little bit more. And Matt, work with me. Bond market's woken up a little bit this morning. Yields are higher, back through 150, 151, up by 5 basis points on the day.
151.
For next year, Matt,
to invest in our country.
America, 2% on a 10-year. BMO 2%, Citi 2%, Deutsche Bank 220, JP Morgan 225, Morgan Stanley 2.1, RBC 2.2, SocGen 225. Man, there's a theme here. It's just in and around 2%. Even with a Fed hike in interest rates, even with inflation close to 7%. Why, Matt?
So, good question. What we are seeing in the markets right now is that while it probably wasn't transitory from the Fed's
great pivot,
there are strong disinflationary pressures in the economy. Obviously, the high inflationary pressures are...
Answer a why question with, well, what we're seeing right now is... Sounds like you're just a reporter. Aren't you at the bank?
Right now, but secularly, demographically, and for other reasons, there are disinflationary pressures. So you marry that with what we're seeing in consumer sentiment. And people are not looking at higher prices right now and saying, oh, I need to get ahead of that. I need to go make that bigger purchase now before it gets even more expensive. Consumer confidence levels are, especially in New York and Michigan, are at extremely low levels. You don't often see this positively strong a labor market.
You don't want to attribute that to the pandemic?
Confidence this low. So what that's telling you is the Fed will have a little bit of help in getting inflation back down. It's probably not going to stay at the 7% level on its own. The Fed's going to help it get down. But you marry the fact that people are not reacting to higher prices by purchasing more. That's affecting consumer confidence. This inflation is already starting to change behavior. So that behavior changing with higher rates, that should lead to a gradually higher rate curve. That's what you're seeing.
Should.
You have a different view on liftoff in the Fed. You have a different view on the rate path at the Federal Reserve. Not just the map, but against most of the market. So, Margie, walk me through how that different view on the Fed means a different view perhaps in the market.
I think that expecting rates to go up substantially, even 50 basis points, most people would think is pretty mild, now appears to be substantial. I'm not even sure we're going to see that on the 10-year. The U.S. rates for 10 years are among the highest of all the developed countries, so there's no relative advantage why our rates should go up.
Correct why our rates shouldn't go up, but people should move to them if our higher quality. Is the U.S. the highest quality? This is now the dollar replacement question.
Secondly, next year, the amount of financing the government will do is actually going to decline. So there'll really be a little bit of a scarcity of long duration treasuries to buy away from the treasury who's been hoovering up all the long duration securities. And I think with rates this low, it just says it isn't really going to affect business decisions. It's such a low hurdle rate that companies can make a decision whether they raise their dividend, whether they make more capital expenditures. And even consumers, I think at this short point on this inflation upswing, are in pretty good shape. They've benefited enormously by the rising housing prices, higher stock market prices, and also wages have started to go up, unemployment is going down. So basically, except for philosophically, there's no reason why the Fed should so-called aggressively act. And so I think the Fed will talk aggressively, but their actual actions will be very, very limited. And even a few 25 basis point rates, I wouldn't define that really as tightening per se. It's only if the Fed starts to say to banks, stop making risky loans, stop lending to these types of entities, that we would be beginning to even think about tightening. It's really in nobody's benefit as far as I can see. And the Fed can't control inflation when it was low. They can't control it when it's high. So I look at interest rate policy as just really something that's there in the background, affecting what sort of investments to make over the near-term horizon, say 1 year.
And Marky, given how deeply negative real interest rates are right now, some people might suggest there's a ton of work to do. You've got an opinion. I imagine it means you've got a concentrated bet somewhere in this equity market that goes against the grain as well. Can you point out where?
Well, I continue to think the areas that have secular growth will do well, because I think next year is going to be another year where the U.S. economy is going to be one of the strongest in the world. So cyclically sensitive, that continues to favor technology, industrials, materials, some parts of healthcare. And I think really, if I'm going to say one thing about real interest rates, if you look historically at interest rates compared to inflation, the so-called real interest rates has been all over the map, from hugely positive, hugely negative. I don't think you can really predict the course of interest rates by that. I think we can pretty much say that the Fed has been able to really control interest rates by their actions. And so that's really what I look at. And I see no sign that they're going to decide intellectually, oh, we should raise interest rates because of maybe a temporary burst in inflation, which may jeopardize their other more important goal, really, which is keeping unemployment low. That's more important to me. So I'm expecting the Fed to disappoint the market once again, year after year. We never get that rate hike people are looking for.
Matt, I know you're taking the other side of this trade.
Wow. Let's hear what the reply is going to be.
Yeah, we're taking it. Again, we respect that opinion. And one of the interesting things about this is, if I had told someone with absolute certainty that inflation is going to be about 7%, give or take, by the end of this year, if you knew that, if you had 100% certainty you knew that, you probably would not have predicted a 10-year treasury at 1.5%. So you have to have a view, you have to have a forecast, but then you have to understand how much conviction do you have in that forecast, and how much do you change your investment portfolio based on forecast. And last year was an excellent lesson that even with perfect forecast, if you knew it's going to print almost 7%,
Perfect forecast,
you probably would have thought rates would be a lot higher, and you would have been wrong. So our conviction for next year in fixed income is to not have conviction, to be underweight fixed income relative in a diversified portfolio, right? But not tilt too much. Don't shrink interest rate duration too much. Don't be too out of treasuries. Be balanced across. Again, we overweight spread products, we underweight treasuries, but the different views in the market shows you that having that conviction and tilting too much would be the wrong call. But we do feel very strong the Fed will not disappoint. Right now, we have the most negative real rates we have ever seen. Blmmbrg data back to 1962, we have never seen negative real rates of this level. And so even if inflation drops to 4%, the Fed funds rate got to 2%, which is probably not going to do, you'd still have negative 2% real rates. That's very stimulative. So we do believe the Fed has switched tack and is going to continue to, and we do believe we will get those 4 hikes next year, even more than the Fed anticipated themselves.
And those deeply negative real interest rates have supported this equity market as well. Risk assets overcoming numerous headwinds this year. On the S&P 500, we've closed at a record high on nearly 30% of trading days through 2021. Bloomberg's Algo Digital has more. Hey, Abby.
Hey, John. Well, it's really pretty amazing the gains that we've had this year. All of these record highs, a third big